TV. Welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today for the first time is Rob Haworth. He is the Senior Vice President and Senior Investment Strategist over at US Bank. Rob, you are coming to us from Seattle, live from Seattle. I want to thank you for showing up for work today because there's a lot of people on the East Coast that have decided to take the day off, but you are right there, front and center, right there in the home base. So congratulations on your Super Bowl victory.
Thank you very much. Yeah, we're very excited here. So maybe easier for us to go to work with that win this morning.
No doubt about it. Well, we got to talk about the market. So last week, leading up to Super Bowl weekend, was a very volatile week. And then we had the big run up on Friday, where you actually had the tech sector pop 4% just on Friday alone. What's your overall outlook for the markets for not just this month, but really going forward for the rest of the year?
Yeah, for 2026, we think that we're fairly constructive, right? We're actually quite constructive, and what we're pointing to is you're getting plenty of stimulus when it comes to the lagged effects of Federal Reserve interest rate cuts. We're getting a stimulus from the One Big Beautiful Bill Act that is going to lift the consumer, and a lot of spending is going to happen around the country, including here in Seattle for the World Cup, as well as our 250th anniversary celebration. And that's before you get to maybe there's some niggling concerns for the market about midterms and other fiscal issues. But we think that really can drive this market forward. I think the second thing I'd point out, the really good news is over the last 3 months, you've seen a significant broadening of this rally. It's happening not just in domestic equities, not just in technology, but it's happening in small companies. It's happening globally in foreign markets. So you're seeing this earnings surge really happen for the rest of the economy as well. And that really is going to be helpful as we move through the year.
So you're seeing leadership broaden out, whereas last year, as you know, leadership is really condensed to the Mag 7 companies. With that, though, is it just a one-off, though, this type of broadening? Because if that's the case, it does seem like that's only because the Mag 7 has been so volatile. But what do you think?
Well, some of it's, yeah, I mean, Mag 7 volatility is maybe a part of it and you're seeing rotation, but really there needs to be, if we think about artificial intelligence as a good driver for this earnings story, there needs to be more winners than just the Mag 7 when it comes to this technology, right? Those of us using it need to see significant financial benefits from spending the money on artificial intelligence. And that's some of what we're starting to see is there are other beneficiaries in this economy starting to creep up. That's why we're getting good industrial performance. We're getting some improvement in the utility sector. You're seeing healthcare as an early sign of a user that's benefiting from artificial intelligence and starting to drive revenue growth. Now, recent performance of the last week has not been great for healthcare, but in general, we're seeing particularly segments of that healthcare market, robotics, insurance, other areas that are making use of this and starting to see earnings expansion. So there is room to grow here. And then if we go back to small companies, that's less about artificial intelligence, more about Fed rate cuts. If we get a couple more Fed rate cuts, that's really easing some of the financial pressure on those small companies who've been borrowing at the higher end of the rate spectrum. And with those rates coming down, they maybe get some relief from that for their finances.
In your opinion, do you think we need Fed rate cuts?
It really looks like the markets and the data is fairly stable at this point, right? And this is a huge week for data. We've been delayed on government data. We had a 4-day government shutdown last week, which delayed the jobs report to Wednesday. We'll get retail sales tomorrow for December, so we'll see how Christmas season looked. We'll get inflation, CPI at the end of the week. I think those are all going to be really important in telling us the story because the Fed right now is stuck in neutral, and I think that's appropriate. You have a softening labor market that stops softening. You have elevated inflation that's not really accelerating. And so they can probably wait and see how does this data really suss out for activity moving ahead. And if it's more labor market weakness, they can maybe cut a little bit more. If it's some firmness in the price level, okay, maybe they can hold off on doing cuts for the moment. So I don't think they need to yet. I think they can be in this wait and see mode. We will probably need rate cuts to get back to neutral over the course of this year, but they have a little time.
Do you think, in your opinion, that with Kevin Warsh going in May, And that's, of course, considering that he is confirmed everything is fine on the Hill. Then the pressure that he will be receiving from the White House, though, do you think that he will be in a position where it's going to be very conflicted? Because right now, even the labor picture isn't as fragile to justify further cuts. And then you have an economy that's still growing, obviously a rising market. But as you know, the Fed only controls short-term rates. So what happens with the drama that could possibly take place starting in June? Because when they meet in June, do you see any type do you think Warsh is just going to push aside all of that drama from the political side, or do you think that that's going to start really making its way into the Fed?
Well, I think prospective Chair Warsh has a lot of work ahead of him once he gets to the Fed, right? It is still a committee. It is still a vote. He's got to convince a lot of people to move his way if he really does want to cut rates. And really for him, as we're understanding it, it's cut rates and shrink the balance sheet, right? So some offsetting factors, and that's a lot of work. That is a lot of work to convince the committee to do and so he's really got a very strong political job that he's got to conduct once he's put in place. And as you point out, that's not a sure thing at this point, right? He's the presumptive nominee, but he's not yet gone to the Senate, and the Senate's making some noise that they're going to take their time. So we'll have to see. But he's got a lot of work to do that convincing. Can he do it? Yes, right? There's room to get to neutral. You've had Governor Myron make lots of points about, maybe needing 50 or another 100 basis points in cuts to get to more closer to neutral based on how they're seeing productivity evolve. But what we saw in the December dot plot for the Fed, and we'll get another one here in March, is the opinions are all over the place. There were a few that really wanted a lot of rate cuts over the course of the next year, and a few that were thinking maybe we could even hike rates, right? We may need to hike rates to fight inflation. So this is not a Fed with a very narrow view on what the forward path should be. And that means whoever's in the chair seat for the Federal Reserve has a lot of convincing to do on what to do next.
Yeah, it's a very smart point. So you started at the beginning here talking about all of the great things that are going on. You mentioned about the spending with the World Cup. That's the first I had heard of that. And then obviously with the big beautiful bill and everything else that's taken place. There's a lot of optimism that I'm getting from you. What can derail that though?
Yeah, I think a couple of things. One, if inflation starts to creep back, that could certainly put a lot of pressure on valuations, right? We know valuations in this equity market are on the high side. And if we see inflation creeping higher, starting to put upward pressure on that 10-year treasury, that is challenging for this equity market. I think thing two, as we saw in the volatility this last week, there's some nervousness in this market around valuations, and particularly around who are the winners and losers in artificial intelligence. And if software is a loser, right? We saw that weakness last week. Certainly disrupted a lot of people. We got a nice bounce on Friday. We were getting another bounce on Monday morning. But if the market really starts to become concerned that the addressable market for a particular sector is much smaller than expected, I think that could derail us for a little bit as well. And then lastly, the good news maybe is we've put some of the government concerns behind us, right? The government shutdown lasted 4 days. We do need to get through one more spending bill, which has some impact in terms of the Department of Homeland Security. But the good news is the government's open until September 30th, and so maybe we've pushed congressional issues out into September as we finally get into election season and get to midterm elections, because we're going to have to elect a new House of Representatives in November and maybe changes in the Senate. So lots of uncertainty ahead that could certainly spook this market a little bit.
Yeah, I do agree with that, and that's good news about the September 30th deadline. Hopefully we'll have a calm summer, but we'll see what happens. So with the themes that are going on, if we do get Fed rate cuts, are there any specific sectors that U.S. bank clients are saying what's in favor at this point?
Yeah, I mean, no, I think the great news for Fed rate cuts is it does support our theme of diversification, right? You're moving beyond that tech sector into some of the more interest rate sensitive sectors will really help. whether it's utilities, industrials, all those stand to benefit here. Small cap as well, right? Small cap should do much better as we get into that into a rate cut cycle if it's one, two, or three. Additionally, we look to pick up some inflation protection in terms of global infrastructure. We think you're well positioned there relative to fixed income to pick up some yield and benefit from what is probably still elevated inflation and the fact that we have a lot of infrastructure build out to do to support artificial intelligence. So global infrastructure could be a great play as well.
So on that, from the portfolio balance, though, I mean, you're still primarily overweight equities, correct?
Correct. Yeah,
So,
global equities. Still prefer global equities relative to fixed income. A little less U.S. given the valuation challenges.
and when you're speaking of fixed income, are you suggesting treasuries, municipals? I mean, what are you saying?
Yeah, very much depends upon your tax situation. Municipals for a surprising number of tax brackets are extremely attractive at this point. It was a real rough first half of 2025 if you're a municipal bond investor. We're seeing some catch up starting to happen. So if you're in one of the middle to upper tax brackets, you're actually benefiting significantly from municipals. And we'd point to high yield municipal bonds as well where yes, they look low quality, but their default rates tend to be much lower than high yield corporate credit. So very attractive there. For the taxable bond investor, we would look more towards structured credit. We would tilt there. We think that there's extra yield to pick up relative to just your core investment grade bond portfolio, and you have some moat. One example would be non-government agency-backed residential mortgage-backed securities, an esoteric small part of the market, but basically mortgage bonds that aren't qualified to be part of the federal agency. So you get a couple extra percentage points in yield. And what we've seen is home equity values are fairly high, right? You're getting a nice moat on these bonds. If we see some distress on the housing market, those homeowners have a lot of room relative to their equity if they do start to be challenged in their mortgage bond payments.
Right. Right. What's your opinion on real estate? Would this be, I mean, it's just been slaughtered the past couple of years, and that entire sector has been decimated. Is now a good time to get in, or should you might want to just stay on the sidelines a little longer?
Yeah, investment real estate. So separating from housing, thinking about the REIT space, investment real estate. It's somewhere we have a position, but we're not getting overweight yet. I think we still have a lot of work through to do, especially in the direct real estate market, where there's still some distressed properties. You still have some overhang in terms of valuations that has to be worked out. It's not that there's more downside, there's just not as much upside as we'd like to see. So we're holding on to our kind of neutral position relative to strategic. We'd lean a little away from office. Office is actually a very small part of the REIT space anyway, and more towards industrials, light industrials, multifamily. There's some value there, but we're not yet at a point where we've seen kind of all the stress on the market work its way out that we're going to see value unlock very quickly in this space.
So you mentioned the risk of elevated inflation. We also have the uncertainty issue, obviously midterm election, geopolitical events, etc. What do you think about metals? The metals trade has just been all over the place. But 2 weeks ago, we saw silver, a week ago last Friday, drop 28% in one day. Is this an area that investors maybe should just stay away from at this point because of the extreme volatility?
Yeah, that's where we'd be cautious at this point, to be honest, right? If we think about last year, gold in particular benefited from central bank buying. They did in 2024 as well. With a market this volatile, it's unlikely we're seeing another round of central bank buying this year. But honestly, we don't know. Interestingly, the People's Bank of China does not call us up to tell us their next exact move when it comes to gold.
Yeah.
If someone does call you up, let us know. We'd be curious. But uh, particularly after that explosive move to the upside and then the move to the downside, what we typically see technically in markets like this is it's going to take time for the bottom to be set again, right? And fundamentals can be constructive in this market in the long run, right? If we do see global central banks continue to ramp their gold holdings, we know the silver market's in somewhat short supply with the electrical demand that's coming for the industrial side of that space. But given the volatility, we think it's best to pause and wait for this market to consolidate, get some of the weak hands out. We think about the flows that happened in January into the ETFs were just huge, and the bulk of those positions are now underwater, meaning below the price they paid to get in. Those probably aren't the strongest holders of any of those ETFs at this point. So this is typically a market that needs some consolidation before it can allow fundamentals to reestablish as the driver of price.
Yeah, you're right. Triple leveraged ETFs as well.
Yeah.
You
Yeah.
might as well just go to the track. That's crazy. So I see that US Bank has an investment webinar coming up on February 25th. Will you be participating?
I will be. I will be speaking along with two of my colleagues, talking. One of my colleagues will be talking about financial planning, and I will be giving our market outlook update.
That's fantastic. Well, just go to usbank.com on that one, guys. This is going to be great. Definitely is going to be an event you will not want to miss. Rob, I want to thank you for joining me today. You were sensational. I can't wait to have you back.
Great. Thank you. So great to be with you, Todd.
Absolutely. So, on behalf of Rob Haworth, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up tomorrow at 11 a.m. live, Christina Hooper from the Man Group is joining me. She's going to help us break down the market a little bit further. So, until then, take care. All right. Rob, that